Hey folks, Simon here with your Tao Daily. Markets had a rough session on Monday. S&P was down 1.75%, Nasdaq was down 2.2%. You can see here on the S&Ps on the 5-minute chart, we had a little gap up on the open. It looked like a continuation of Friday's rally, was in the offing, and then fell down, a bit of sideways chop, and then a real collapse late in the session once the market found out that tariffs of 25% are being enacted on Canada and Mexico today, and the tariff on Chinese goods is doubling from 10% to 20%. Now, the market had believed that these tariffs would be punted for at least another month, and so their sort of unequivocal introduction today came as a surprise. All right, so we started off in the green, we finished in the red. Very bearish day. This is a bearish key reversal where the bar opens at above the previous session's high, closes, well, actually we didn't close below the previous session's low. So it's a bearish engulfing. It's not a bearish key reversal, but pretty bearish nonetheless. However, now is probably not the time to be getting maximum bearish the market. Why? Well, because everyone else is. How do we know that? Well, we can look at a chart like this one. This is the 7th most bearish reading on the AAII percentage of bears poll. Previous spikes occurred very close to market bottoms. We had one in 2020. We had a couple in the global financial crisis. We had a couple in the early 90s here, but this level of bearishness is kind of unprecedented for a market that is still, within 5% of all-time highs. Now, strategically, yeah, I think there are good reasons for caution. Another reason I say that is just that this is the economic policy uncertainty index for the United States. We looked at this chart last week. You can see the spike here is the second highest we've ever had. Previous spikes were during the COVID crash, during the global financial crisis. This is when Lehman failed. We had a spike here during 9/11, and we had a spike here during the Russian bond crisis when long-term capital management went broke. So this very, very high level of economic policy uncertainty is a negative for markets because markets hate uncertainty. But in the very short term, we are looking at a market that is potentially probing support here down the bottom of the box, and a market where potentially everybody is already bearish. Now, what happens when everybody's already bearish? Well, you can tend to run out of sellers. And when you run out of sellers, guess what? The market tends to stop falling. Now, I know a minus 1.75% close feels really bearish, but have a look at this one. That was down almost 3%, V-shaped bottom. That was down 1.68%, rallied straight off that level. This recent low here was down 2%, again, rallied straight off that level. All right, so the lesson here is that a big move down feels horrible, feels bearish, but it's no guarantee that markets are going to keep plunging. The key in this sort of environment is to stay nimble, trade small, keep risk low. And personally, I'm just maintaining a balance of long and short positions until we get a clearer trend. That's it for today. I hope it helps. I'll catch you next time.